All right, they're telling us that Amberle is a listed company with divisions which manufacture cars, motorbikes, and cycles. So, over the last couple of years, Amberle has used a mixture of equity and debt finance for the investments. However, it wants to make a new investment of 150 million in facilities to produce electric cars, which it proposes to finance solely by debt finance. So the project, so when you look at the project, and the finance director has prepared estimates of the post-tax cash flow for the project, and they're using a 4-year time horizon, looking at the realizable value at the end of the 4 years. So you have the post-tax operating cash flows and the realizable value. So then we have working capital of 6 million. It's not in the above estimate, and it will be funded from retained earnings, which will also be required immediately for the project, rising by the predicted rate of inflation each year. And any remaining working capital will be released in the full at the end of the project. So then you have the predicted rates of inflation that are given to you. So you have the years and the inflation that is given. So the finance director has proposed the following finance package for the new investment. They want to do a bank loan, which they pay in equal annual installments over the project's life, where the interest is payable at 8% per year. That is the 70 million. But they also want to get a subsidized loan from the government loan scheme over the project's life, on which interest is payable at 3.1% per year. That is 80 million. Issue costs are for 3% of gross proceeds payable on the subsidized loan, and no issue costs to be payable on the bank loan. And these are not taxable, are not allowable for tax. Then they're saying that Amberle pays tax at a rate of 30% on profits in the same year in which the profits arise. The asset beta is currently at 1.14. Return on the market is 11%, and the risk-free rate is 4%. So suitable or equity discount rate of the project is 12%. They have given us this figure, but for us, we are going to try to confirm it if they calculated it right. In the exam, when you are doing this, you don't have to go back and calculate 12%, because this is calculated using capital pricing model. But you would need to first of all confirm. For our case, in the exam, you don't confirm, you just take what is given. So the chair has noted that all the company's debt, including the new debt, will be repayable within 3 to 5 years, and is wondering whether we need to develop a longer term financing policy in broad terms, and how flexible the policy should be. So now, the reason we are looking at this is trying to look at adjusted present value, and I'll just introduce adjusted present value. So for adjusted present value, it tries to look at, first of all, the cost of capital, where it only considers everything being equity financed. So you have to first get the net present value of an all equity finance project. Then you adjust for the effects of debt. And basically, this is that's why we call adjusted present value, because we first assume that it's all equity financed. And then we bring in the debt aspects. And what aspects do we normally bring in? We bring in the tax savings from the interest payment. But we also bring in issue costs. And then we also bring in the subsidies. Because most of the time when they ask this question, we shall have subsidies involved. And the subsidy is when you are going to benefit from something that not everyone else is benefiting. Like if the government, for example, subsidizes education for a few people, the idea here is that the subsidy would help you to get the money cheaper than you would have gotten them before. The reason could be maybe they are trying to develop that part of the industry where you're operating, and they are giving some kind of incentive. So these are like incentives, the subsidies. So now, as we said, we need to calculate the adjusted present value, and we start from the net present value when it's all equity financed. So we shall have our years. The project is going to be for 4 years. And they gave us the cash flows in millions of dollars. So we shall work in millions here. Okay. So they gave us the post-tax operating cash flows. We have 28.5, 36.7, 44.4, and 50.9. Then they gave us the realizable value. $45. That's what we have. Okay. So now what you want is to also put the amount of what you're going to invest. Remember, we are going to invest 150 million. So investment 150 million. Okay. And then so we have also working capital. We shall need 6 million immediately, and then we shall also raise it by inflation. So we need to make a working capital working. So we are going to need the years. Again, we are working here in millions. So these are the years. So what is working capital needed? We're going to need 6 million immediately. That is 6 million. Then it is going to grow by inflation. So in year one, to grow by 8%. Then in year two, by 6%. Then in year three, by 5%. Now year four is the last one. So we are not going to grow the one in year four. So now, but we don't take the entire working capital, Because if I have 6 million, then I just need what gives me 6.48. So what I need actually is the change. So of course the first one will take the entire 6 million, but then the rest will just subtract. Okay. And then in year 4, we recover everything. So that is 7.21. So that is our working capital. Okay, so after that, we now can get our total cash flows. Total cash flows. And then, as I said, they gave us the discount rate, but they gave us the risk-free rate, the asset beta. So we can try to calculate this 12% had we not been given the 12%. So how do you calculate? How do you calculate using the capital asset pricing model, which is going to be given by the risk-free rate, which in this case is 4% plus beta. In this case, we want the asset beta because we are looking at all equity financing. 1.14 multiplied by the market return, which is 11%, minus the risk-free rate, which is 4%. So you can see that the answer is 11.98, which they gave us here as 12%. So we are going to use this one. So given that our years are contiguous, I can get NPV at 12% using the formula, which you can use, as we said. You need to know the rate, give it cash flows from year 1, and then you subtract the initial investment. So that gives us minus 5.15. And of course, so if it were to be 100% equity financed, then we would not take the project because it gives a negative NPV. But they wanted us to get adjusted present value. So we need to make adjustments. And the adjustments that we make are those adjustments that are coming in as a result of the debt. So now, which adjustments are those? So 1, issue costs. Now, issue costs, they say that issue costs are 3% of the gross. So, which means that we want, you see, when you go to the bank and you want a loan and you want 20 million, if there are going to be some issue costs, then you end up with less than 20 million. So what you would like to do is to go to the bank and tell them, I want, after you remove your issue costs, to take 20 million home. So the bank loan will be of more than 20 million, but then after the issue cost, you will be at 20. So it means that this amount here of the subsidized loan of 80 million, in actual sense, it is not 100%. It's not the gross amount of the loan, but rather the net after removing the 3%. So if I want to get the 3%, I just need to say what is 3% but not 3 of the gross of the net. So 3 out of 97, because this is just only 97 which is left. Multiplied by the 80 million. So that is 2.47 as the issue costs. And these are paid usually immediately, so we don't have to discount them. So, and they are negative because they are going to be an expense. So I'm going to put them there as a negative. Then the other thing that will also influence is the tax. They call the tax shield. Okay? Or the tax saving from the interest payment. Now, so the tax shield from the interest payments would be how much you're paying as interest, and that will give you the tax shield. So remember, it is 80 million, and of that 80 million, the tax payable is 30%. Okay? So that should give you the interest, the tax that you would have paid. But that is, you are saving that every year. Okay? So you're saving it every year, and therefore, you need to kind of get the, okay, maybe I should explain it. Every year when you pay interest on this loan, you get a tax saving. So means that this saving that you are having here is actually an annuity. So if you went to the tables, and let me open up the tables. If you went to the tables, now when you are discounting the for the tax shield, you actually can do either of two things. You can use the rate of 8%, which is the normal rate of borrowing, or you can use the risk-free rate of 4%. But actually not 4%, because they are giving it us at 3.1. That's the subsidy that they are giving us. But most cases, it is much better to use the 8% of the normal interest. So 8%. So you're going to go here, 8%, and then you are looking at the you have to be an annuity table, so 8%, and then you are looking for the 4 years, so 3.312. So multiply this by 3.312. Now that will bring all the values of your tax at year one, because annuities start from year one. But we want to bring it to present value. Okay? I bring it from to present value. So we have to multiply again by the discounting, again still at 8%. Let's see. So as I said, now this tax saving, that this tax shield, you are paying 80 million and you are paying 30% of it every year, and then you use the 3.312 to get the what? The annuity. However, when you are looking at the tax shield on this loan, the subsidy loan, they are telling us also that we are getting it at 3.1%. So what you could do, maybe think of it is that ideally, how you think of it is that you first calculate the subsidy, but then you calculate the tax shield. But the tax shield is not going to be the entire 8% that you normally get, because while everyone else is getting it at 8%, for you, you are actually getting it at less than, okay, at 3.1%. So when you get 8% and remove, or you can look at the 3.1 that you're paying, because this is the interest. So this is 80 times 30%. Actually, you start from 80 times 3.1%. That's the interest. Then this is the tax 30% that you're saving on it. Then multiplied by 3.312. So that is the tax shield from the interest payments. And this is a benefit, so it's going to be positive. Then you also have the tax shield from the normal borrowing. Now for this one, the normal borrowing is repayable in annual installments over the project's life. So for it, it's repayable in equal installments. So we are going to amortize, sort of. So now, I remember, I think I told you that sometimes you may need to amortize, and this is one of those cases where I need to amortize. And how do you amortize? Because this is the amount that we are dealing with, 70 million. So we need to first of all know how much we need to be in terms of the principal, but also the interest. And then from there, we can now determine how much you are going to be paying per year. So to do that, we are going to have to get this figure of 70 million. So to get the annual, so I think we may need the working on this one. So we can call this one working 1. Then we can call this one working 2. Normal loan amortization. So for you to amortize, the first thing that you need to know is the amount that you're going to be paying on an annual payment. So what is the annual payment? So the annual payment is basically the 70 million divided by the annuity factor of the 8% for the 4 years. So which we got as 3.312? This figure here. 8% for 4 years, 3.312. So divide by 3.312. So that's the annual payment, 21.135. So from there, you can now try to amortize. So that's the first year, second year, third year, fourth year. So you have the opening balance. This is how they amortize. You start with the opening balance. So the opening balance at the start of the year is the entire 70 million. Excuse me. 70 million. Then interest is paid or it accrues. So that is 8% of the opening balance. Then the repayment is this figure here, 21.14. Then you have the closing balance. So now the closing balance is going to be 54.46. And now that becomes the opening balance of the previous year. So the interest is still 8% of the opening balance. So I can drag this. And the repayment is still going to be the same 21.14 because that's the annual payment that you are making. And then the closing balance. So you realize that when you amortize like that, at the end of the fourth year, you don't have any balance. So you have paid out everything. Now the interest itself is here. Okay. So now to calculate the tax relief, you are going to now again, you can copy the years just to not disturb the figure up. So you have the interest, which is basically this amount. So for that interest, then the tax relief is the 30% that you would have paid on it. So now after getting your tax relief, then you can actually get the net present value of that relief. Remember, we are doing it at 8%. Since these years are contiguous, you can just do NPV and you give it 8%. You give it the cash flows, the tax relief. So that is 3.74. And that is what you are going to bring here as the tax relief. Remember, these adjustments here are in net present value terms because we are going to adjust them on the NPV. So we bring everything in present value. That's why we have done the present value computation here, as opposed to just adding them. So then the other thing is the subsidy itself. Of course, because other people are paying 8%, and for us, we are only paying 3.1%. So it means that you get the 80 million multiplied by the difference between 8% and 3.1%, because that's the benefit. Now, but with this subsidy, we don't want the subsidy with the tax component. Remember, tax is 30%, so we multiply by 1 minus 30%. Remove the tax component because we have already dealt with it in the tax shield from the interest payment on the other subsidy payment. And again, this is going to be every year. So for 3 years, so we need to multiply it by the amortization of 3.312. This same number that we are using here for the 4 years annuity. Okay. And that's a benefit as well. So I think we have all of those. So we can add them. So these are the total financing side effects. And now you can get the adjusted present value as the sum of these two. And you can see that it is positive. So it is positive. Therefore, project can be accepted. Okay. I don't know if there are questions on what I've just done. Especially Monica, who wanted to understand more about this. I don't know if it's clear.
Yes, but my first question would be, why did they give us the CAPEM, the CAPEM, those are the risk premium, and what yet they had actually given us the discount rate of 12%? Was it just to confuse us, or because ideally someone would first work it out in an exam?
Yes. And most cases they won't do that. What I'm thinking, what I think they did here, because these questions have been updated based on the syllabus changes that have occurred. Before, when they used to not have these 5 marks here, perhaps they wanted you to calculate. Okay, and since they now have put these 5 marks for professional skills, so they reduced on the weight that they are giving to the computation, and that's why they gave you the rate. Okay, so that's one of the reasons. But the other reason, like as I mentioned, you could have used for discounting, when you are discounting uh, the financing side effects, you could have discounted them on using the risk-free rate, or using the 3.1, the subsidy interest. But most cases you find they are using the normal interest payable. So I guess the reason must be that they reduced the weight on the numbers, so they had to give you this. What the examiner is just trying to see whether you understand that all this information given to you here is really for you to arrive at 12%. And therefore, if they give you the 12%, then you shouldn't calculate. Okay, any other questions? Okay, so we can go to the next part, where they are looking at factors that may determine long-term finance policy, and the factors that may cause the policy to change. Now, when it comes to financing, the factors that you consider have to do with first of all, the ease with which you can get the finance. So factors consider it's going to be with ease of getting equity or debt. First of all, because ideally this question is asking us what we should consider whether when we choosing to use equity or debt financing in the long term. And the thing is, you may not even have a choice to begin with. So that's the first point. If a company is not listed, then perhaps it is not easy for you to get debt financing. So, but if it isn't able to get any of this, then it has to now look at such factors. And one of the factors that you can consider is whether there is an optimal gearing for Amberle. So, and this is one of those theories where we look at Modigliani and Miller without tax, and even the traditional view of looking at it, and then also the Modigliani and Miller with tax. If there is an optimal gearing for Amberle, then it will determine whether they get more debt or equity. Because if they are not yet achieving that optimal gearing, then that means that they have leeway. They can manipulate and be able to actually get more debt until when they reach that level, then they can maintain and they start getting an equal mix of debt and equity. If they are above that optimal level, then they can get equity to try to drive it back to that optimal level. Then they start balancing it at that point. So that is really one of the things that we might consider. Then there is another theory called the pecking order. And anyway, this kind of links to the ease of getting equity or debt. Because this theory states that when you have to get finance, you start from retained earnings, then you go to short-term debt, long-term debt, then you go convertible debt, then you go redeemable preference shares, then redeemable preference shares, then ordinary shares. There is an order. And that order, when you look at it, is just the order in which the cost becomes more and more expensive. So you'd like to maybe follow that. Then then another thing that you can do is what we call the matching. Another thing that can affect is matching. So and here, especially when you are trying to look at foreign exchange, you may try to have some investments, and therefore you choose to have corresponding debt borrowing, that they are in the same currency, and therefore you are able to match the receipts from those payments. So then they asked us to also look at those factors that may cause the policy to change. Now, what causes the policy to change? One is if the investment is, let's say, riskier than the project. Now, here we are looking at cost of capital. If you have another investment that you want to make, but that investment is more risky than the business as a whole, let me just say the company. So what you do, then you don't use the same financing strategy that you've been using for the companies. You can try to maybe look at the specifics of that project, and maybe that project specifically may require you to use equity or debt. Now, like this one here, basically this one we have calculated was not really going to work out for equity, and yet for debt it does work out when you finance it with debt. So that is one of the things that you may choose. And why would that, when would this happen? It could happen, excuse me, if Amberle were to change their business substantially. You've been selling cars, Then you now want to do a project which is completely different. Like maybe now you want to manufacture maybe beds. So that may force you to change your gearing. So uh, then perhaps it is not you having that change, but there has been a change in the environment of operation, like economics. Okay, so maybe data has become very expensive now because of the inflation that has been happening, and therefore you start trying to back off from debt financing. Okay, so that is an external force that is causing you to change your policy. Uh, then we can also look through the scenario to see whether they said something after they said that the chair has noted that all over the company's debt, including the new debt, will be repayable within 3 or 5 years. They are trying to look at a longer term financial policy in broad terms and how flexible this policy should be. They are now looking at flexibility. So if you are looking at flexibility, then usually debt which is redeemable is more flexible than equity. And in fact, short-term debt is even more flexible. So what could change this policy is probably the desire for a more flexible mode of flexible cost of capital. And here, what we mean by more flexible is that you don't want to be tied in for so long. Like you can get debt which is irredeemable, or even preference shares that are irredeemable, or even ordinary shares. Uh, when you get that, you are basically getting like shareholders, co-owners of the company, and it becomes now difficult for you to start changing up policies and everything. Yet, if you are having debt, like now this one which is about to be fully repaid, it means that you have the flexibility of not having to basically not having to deal with, like, not being rigid. If the loans get done and the debt is fully repaid, then you have a choice to make at that point. Whereas for interest, I mean for for equity and the preference shares that are irredeemable, you kind of are fixed, because unless people sell, then you are most likely not going to have a big change. And even if they sell, the ownership still not come back to you, because they normally sell on the secondary market, and therefore you may not have uh, quite a flexible way of changing your policy, because you have to get a buy-in from the shareholders if you want to change the gearing of the company and all that. So that's what they say. What factors may change the policy. So I don't know if you have any questions. No? Okay.
But
Uh,
I think I'm now okay. My issue was on the benefits and how we the annuities
okay.
discounting them. So
Okay.
I'm good. Yeah.
Yes, good. Now, like I said yesterday, what I want you to do is to go and do the questions on the practice platform and the mocks, and then when you do them under timed conditions, so that you are aware that you are able to do these questions like on time. Because now I think you have limited time. The time you have left should be for one, making sure that you have those theory aspects very well covered. And the good thing, you have pocket notes. Pocket notes tend to have a good summary. It's a my advice that you read through the entire thing. It is not so big. Then you do those questions timed. Then you can send some of them from it for feedback in case you want. But I strongly would advise it. Then you do the mocks also, and then make sure that so that by the time you got the exam, you are really conversant with what you're expecting, where the formulas are, how to answer section A questions with the report and all that. So I'm not going to proceed today because, as you can tell, I am not doing so well. So I wish you success, and then I'll be waiting for you to tell me what happens when you're doing some of these questions, and then we see how to deal with it. Thank you, and have a good night.
Thank you very much, Herbert.
You're welcome.